The S&P 500 is up 0.7% today, reaching a price of $7,489. But what's really catching our attention is the significant move in ISC, which has surged 30.27% to $744.54. This drastic increase is not only a standout in today's market, but also a reflection of the current state of the economy and investor sentiment. As we delve into the reasons behind this move, it becomes clear that earnings and sector rotation are key drivers. The fact that ISC is outperforming its peer group today, with a 52-week range of $309.51 to $804, indicates a strong demand for its stock. This move is particularly interesting given the current macro environment, where the VIX is down 6.44% to 16.0, suggesting a decrease in investor fear and uncertainty. Zooming out to look at the broader macro environment, we're currently in a neutral regime with mixed signals. The S&P 500's 0.7% increase today, coupled with the 10-year Treasury yield rising to 4.745%, suggests a complex interplay between growth and inflation concerns. The dollar, as measured by the DXY index, is down 0.19% to 99.726, which could have implications for foreign trade and investment. With gold up 0.34% to $4,120 and oil down 5.76% to $79.79, it's clear that investors are navigating a multifaceted market landscape. The current regime indicates that the next catalyst, whether it be Fed speakers, CPI data, or earnings revisions, will be crucial in determining the market's direction. Let's take a closer look at ISC, the top gainer today. With a price of $744.54 and a gain of 30.27%, it's evident that investors are betting heavily on this stock. The key driver behind this move seems to be the combination of strong earnings and sector rotation. ISC operates in a sector that's currently in favor, and its ability to beat earnings expectations has not gone unnoticed. The 52-week range of $309.51 to $804 suggests that ISC has been on a significant upward trajectory, with today's move being a continuation of that trend. Peer comparison shows that while other stocks in the sector are also performing well, ISC stands out due to its exceptional relative strength. The RSI level and one-month trend indicate that ISC is not overbought, despite its rapid ascent, suggesting there might still be room for further growth. Moving on to another significant mover, the XDI has gained 28.74% to reach $60.43. This move is also driven by earnings and sector rotation, with AXDI benefiting from its position in a currently favored sector. The 52-week range of $1.90 to $143.16 for AXDI indicates a volatile but overall positive trend, with today's move being a significant upward spike. Social sentiment around AXDI is positive, with retail traders expressing optimism about its future prospects. However, it's essential to consider the risk factors, including the potential for earnings disappointments or sector rotation away from AXDI's sector. Comparing AXDI to ISC, both are experiencing significant gains due to similar drivers, but their industry context and peer comparison reveal different stories. AXDI's move is more about its specific earnings performance and less about broad sector trends, unlike ISC, which is riding a sector-wide wave. As we examine the cross-asset signals, Bitcoin's price of $62,876, down 0.98% today, suggests a cautious approach to risk assets. The trend in Bitcoin often signals risk appetite, and its current movement may indicate a slight decrease in investor willingness to take on risk. Gold, as a safe haven asset, is up 0.34% to $4,120, which could suggest that some investors are seeking safer alternatives. The 10-year Treasury yield at 4.745% implies that investors are demanding higher returns for holding longer-term bonds, possibly due to inflation or growth concerns. The relationship between these assets and the S&P 500's current price of $7,489 suggests a complex interplay of factors influencing the market. The Fear and Greed Index, though not explicitly mentioned, would likely reflect a mix of emotions given the current market conditions. In terms of sector rotation, the best performing sector ETF today is Consumer Disker, XLY, up 3.29%, followed by Communication, XLC, at 1.56%, and Energy, XLE, at 1%. This rotation towards consumer discretionary and communication sectors may indicate that investors are favoring areas that could benefit from current economic trends. The supply chain ripple effect for ISC, considering its upstream suppliers and downstream customers, suggests that its success could have a positive impact on related industries. An ETF like the Consumer Discretionary ETF could provide diversified exposure to this theme, allowing investors to capitalize on the trend without being overly exposed to individual stock risks. Before moving on to the action plan, it's essential to consider the broader implications of these market movements. The fact that ISC and AXDI are leading the charge, along with the sector rotation and cross-asset signals, paint a picture of a market that is both optimistic about growth and cautious about potential risks. As investors, understanding these dynamics is crucial for making informed decisions. The upcoming CPI inflation report in about 8 days will be a critical catalyst, as a hot CPI reading could lead the Fed to maintain a hawkish stance, potentially impacting the market's direction. Now, considering the moves of other significant assets, RBLX has dropped 26.85% to $35.60, and VCYT is down 22.52% to $46.32. These losses are significant and reflect a different story than the one told by ISC and AXDI. The reasons behind these drops are varied, but often related to earnings disappointments or sector rotation away from these stocks' respective sectors. For investors holding these stocks or considering them, it's crucial to reassess their portfolios in light of these changes and the broader market context. As we analyze these movements through the liquidity lens, focusing on flows, Fed policy, and momentum, it becomes apparent that the current market environment is highly sensitive to news and data releases. The value lens, on the other hand, emphasizes the importance of P/E ratios, competitive advantages, and long-term earnings power. Through this lens, investors should consider whether the current prices of ISC, the XDI, and other movers offer value or are driven by enthusiasm. The interplay between these two perspectives provides a comprehensive view of the market, highlighting the need for a balanced approach that considers both short-term momentum and long-term fundamentals. Given the complexity of the current market and the significant moves observed today, investors must stay vigilant and adaptable. The next catalyst, whether it comes from Fed speakers, CPI data, or earnings revisions, will play a crucial role in determining the market's direction. As we move forward, understanding the drivers behind these moves and being prepared to adjust investment strategies accordingly will be key to navigating this multifaceted market landscape. The S&P 500 closes at 7,489, up 0.7%. The VIX drops 6.5% to 16 even. Gold ticks higher to 41.20. Bitcoin slips just under 63,000. Oil gets hammered, down nearly 6% to 79.79. And the 10-year yield jumps 17 basis points to 4.745. Every market moved today, but they didn't move together. That's the story. In a neutral regime with mixed signals, correlation breaks down. The next catalyst, CPI in 8 days, earnings revisions, Fed speakers, becomes the only thing that matters. Stock picking beats index betting. Individual analysis beats macro calls. Let's break down what moved, why it moved, and what it means for your portfolio, asset by asset, trade by trade. Start with the big picture. The institutional desk sees a risk-on undertone at 67% confidence. Historical parallel, early 2023, when rate hike fears eased and the rally broadened. But, and this is critical, we're mid-stage. Confirmation or reversal signals are what we're hunting now. The evidence is split. Equities bid, S&P up 0.7%, NASDAQ up a full percent at 25,373. But the 10-year yield also rising, up 17 basis points. That's not the clean risk-on playbook. In a pure risk-on move, yields usually fall or hold. Here they're climbing. Inflation concerns? Growth expectations? Term premium? The bond market isn't confirming the equity move. So the playbook for this regime: overweight equities, lead with high beta, growth, small caps. Underweight bonds, duration risk not rewarded. Gold neutral, opportunity cost versus equities. Crypto overweight, high beta plays well here. Dollar underweight, typically weak in risk on. Commodities overweight on demand assumptions. But, and I cannot stress this enough, correlation between assets is broken down. The VIX at 16 suggests complacency. The dollar index at 99.72, down 0.2%. Oil down 5.8%. These aren't moving in lockstep. That means stock picking over index betting. The next catalyst wins. Let's start with the indices, because the headline numbers hide a massive divergence. The S&P at 74.89, up 0.7. NASDAQ at 25,373, up a full percent. But the Russell 2000 down 0.5% at 29.31. Small caps lagging. That's not broad participation. That's mega cap leadership. This content is for educational and entertainment purposes only. It does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions.